Bitcoin is down more than 30% from its all-time high. Over the past 2 months, more than $6 billion has flowed out of Bitcoin ETFs. Roughly 400,000 Bitcoin miners have gone offline. Mainstream media is repeating the same narrative. Liquidity is drying up. Crypto Twitter is in full panic mode. Everyone is selling. Everyone is scared. But beneath the surface, something very different is happening, and almost no one is paying attention. While retail investors are liquidating out of fear, Circle and Tether quietly minted over $2 billion worth of stablecoins on Solana in a very short period of time. And if you've lived through at least one full crypto cycle, you already know this. Stablecoins are never minted at random. They are only created when real USD enters the crypto system. So when someone is willing to deploy $2 billion in cash, it usually means a very large move is being prepared. And at that scale, it's rarely noise. It's often the early signal of a market structure shift. This isn't the first time we've seen this pattern. In previous cycles, 2021 and again in early 2024, large stablecoin minting events appeared before the market narrative changed. So the real question isn't whether this is bullish or bearish. The real question is, what is actually happening behind this $2 billion number? And before anyone thinks this is in financial markets, there's one principle I repeat constantly. Liquidity is king. Price is just its shadow. When Tether or Circle issues new supply, most people assume that money is immediately going to buy tokens. That's not how institutional capital works. From an analytical standpoint, this $2 billion is best described as dry powder. Why dry powder? Because stablecoins don't appear unless there is real demand. Tether and Circle don't speculate. They respond to institutional requests, funds, desks, or large players deposited fiat and requested on-chain stablecoin liquidity, which leads to the most important question. Why Solana? Why not Ethereum layer 2 like Arbitrum or Optimism? Why not emerging chains like Sui or Aptos? The fact that $2 billion was minted directly on Solana in a short time window is quantitative evidence that hot capital currently prefers Solana. This does not mean Solana has replaced Ethereum. It simply means that at this moment in the cycle, liquidity is choosing efficiency. Historically, when dry powder enters the system, it does not mean prices pump immediately. Instead, it acts as a buffer. If the market sells off, it buys the dip. If the market goes sideways, it farms yield. That's why the right question isn't, will Solana pump? The better question is, are we seeing early confirmation of a structural liquidity migration towards Solana? We'll need more data to be certain. But $2 billion. Now, let's step away from narratives and look at network performance. I don't care about promises. I care about what's actually being used. Why did Circle and Tether choose Solana? The answer comes down to 2 words: payments, velocity. First transaction cost and speed. In a macro environment where interest rates still matter, smart money is extremely sensitive to friction. Solana allows $1 or $1 million to move at nearly zero cost and settle in seconds. USDC on Solana is no longer just a speculative tool. It's becoming a payment rail. Second, traditional finance integration. We've seen PayPal launch PYUSD on Solana. We've seen Visa-linked partners integrate Solana infrastructure. This $2 billion mint, in my view, is about reinforcing liquidity depth for institutional operations. Large players need deep pools to execute size without slippage third DX market share. Look at decentralized exchange volumes. On certain days, Jupiter and Radium on Solana rival or exceed Uniswap on Ethereum. You cannot sustain billions in daily trading volume without deep stablecoin liquidity. So this mint isn't random. It's infrastructure preparation for a new baseline of activity. Tether and Circle are businesses. They follow real demand, and right now, the data says that demand is on Solana. Now, let's talk about what most of you actually care about. Opportunity. Not price predictions, but capital behavior. When $2 billion enters an ecosystem, it doesn't spread evenly. It moves in phases. This is called capital rotation. Phase 1, yield positioning. Smart money never sits idle. The first destination is lending protocols. Camino, MarginFi, Solend. Why? Stable yield with minimal risk. If Solana total value lock spikes in the coming days, this is likely where the money is parked. This is accumulation, not speculation. Phase 2, risk on deployment. Once positioned, a portion of that capital is used as collateral to borrow Solana or ecosystem assets. This is where price impact begins. You'll also see retail liquidity rotate into meme coins. And I need to be very clear, that's gambling, not investing. Historically, 99% of meme coins trend to zero versus Bitcoin. Phase 3, narrative expansion. When Bitcoin stabilizes, capital looks for growth. In this cycle, two narratives stand out: Depend and AI. Not because they're trendy, but because they solve real problems. Physical infrastructure, compute, energy, data. Crypto provides coordination layers for all of it. This isn't the FOMO phase. This is the positioning phase when smart capital moves quietly, while the market still doubts. And if you understand cycles, history doesn't repeat, but it often rhymes. Every time we've seen positive stablecoin supply expansion, the broader crypto market has tended to respond 1 to 2 weeks later. Why the delay? Because capital needs time to deploy. There's also a confidence effect. After FTX and network outages, institutions were cautious. This $2 billion mint is a vote of confidence. It says, we trust this network to handle institutional scale liquidity. I won't give price targets, but from a structural perspective, this level of liquidity likely raises Solana's price floor. However, watch Solana to Bitcoin, not just USD. If Bitcoin dominance continues to rise, Solana can go up in dollars and still underperform Bitcoin. The most constructive scenario for Solana is Bitcoin moving sideways while this liquidity rotates. That's when relative strength appears. But let's be clear about risk. Risk 1, centralization. Solana is increasingly dependent on USDC and USDT. If regulatory pressure hits issuers, that's a systemic risk. Ethereum has more diversified stablecoin exposure. Risk 2, network stability. Liquidity increases transaction load. This is a stress test. If the network fails during heavy use, final thoughts. The $2 billion stablecoin mint on Solana is bullish from a data perspective. It confirms Solana's relevance in the current liquidity cycle. But smart investors don't chase headlines. They watch behavior. Track total value locked. Does the money stay? Watch Jupiter volumes, real trading, or casino activity. Manage risk, never all in. In this market, the winners aren't the ones who predict price. They're the ones who wait for capital to act and follow it patiently. Thanks for watching. If you value calm, data-driven analysis over hype, consider subscribing. I'm Ben Morgan. I'll see you on the other side of the chart.